But we have an industry voice now joining us to help us understand and analyze the situation much better. G.Shivakumar, Executive Director at G Shipping, is joining us. Mr. Shivakumar, good morning. Thank you so much for your time. We'll come to your business in a moment, which I'm assuming doing very well right now. But I want to understand what Snehi was bringing to the table. And this issue has been ongoing and has been worrying a part of the industry for last few days now. How do you see, and what is the data which you're reading?
Yeah, morning. Thanks for having me. I think the facts that she's put out, they are indisputable. The Suez Canal is the quickest way to get from east to west, from Asia to Europe specifically, and having to go around the Cape of Good Hope obviously reduces the effective shipping capacity and could result in a significantly tighter market. So that's absolutely true. And about 10% of the trade goes through the Suez Canal and could be affected if the situation continues. The situation currently is still evolving. So all the names that were mentioned are container players who have said that they'll take the Cape of Good Hope route rather than the Suez Canal route. So far, we haven't seen significant changes in any announcements from too many tanker companies. A couple of them have said that they'll avoid the Red Sea Suez Canal route. So, but if this persists, we have not seen a big change in rates except for on the routes which are specifically dependent on that trade. So those rates have gone up a lot. So we haven't, not too much except in individual routes. But yes, if this continues, you could see a more widespread tightening of the market for tankers as well.
Interesting. Because nearly 28% of container volumes move from that area. But Mr. Shivakumar, what about shipping companies? Are they revising their contracts just yet, or are they still in wait and watch mode?
Commodity shipping companies like us, again, we are dependent on how the route that the customer wants to take. And we can choose, and these are negotiated on a voyage by voyage basis sometimes. If you're on time charter, then it depends on the clauses in your contract. People are tending to avoid the Red Sea and that route. However, it is not an overall, blanket ban like we have seen announced by the container companies. So if it persists, and again, we don't know how it's going to evolve. Maybe it'll die down in a few days. Maybe the proposed naval escorts could be effective. So if it continues for a significant period of time, that means a tighter market for containers, which we are not in, and tankers. Dry bulk has less of an impact. 4 to 5% of the trade goes through the Suez Canal.
Kumar, just as per your understanding, what would you think really needs to change, or what really do you think needs to be done in order to resolve this and to make the shipping companies once again take this route?
So that's geopolitics, and we don't have any expertise there. Basically, we'd like it to settle down and for safe passage for all ships, because it's a big worry, right? If your ship is going there, your crew are there, you have cargo there, and you don't want anything to happen to your people, to the cargo that we're carrying for our customers, to the ship itself. So the ideal is for the whole thing to settle down, but that's way beyond our pay grade. That's something that needs to be settled between the players involved.
Mr. Shivakumar, let's shift focus and talk about the business then. Where exactly do we stand in the cycle right now? Because as we see it, the order books right now of shipyards and dry bulk carriers, all of them are at multi-year lows. Where do you see things shape up from here on?
Yeah, so the order books, as you said, are very low, which is good because future supply is somewhat restricted, at least for the next 2 years. The tanker market continues to be tight, even without this additional factor on the Red Sea. So the markets were, crude tankers were earning $40,000 to $50,000 a day on average. Product tankers were earning $25,000 to $30,000 a day, $25,000 to $35,000 a day on average. So that's still a very healthy market. Dry bulk carriers, which were going through a weak patch, are now much stronger. So the smaller bulk carriers are earning between $15,000 to $18,000 a day. The bigger, the Cape sizes are earning in excess of $25,000 a day. So across the board, there is pretty good strength. And LPG, of course, has been hitting all-time highs, LPG ships in the spot market. And apart from that, we also have the oil field services business, which is the offshore drilling and support vessel business, which has also been strengthening for the last year and a half. And all contracts, every contract gets repriced higher than the last one. So across the board, we are seeing strength in a lot of our sectors.
Shivakumar, just a quick follow-up on that one. So what I get a sense from your answer is that the outlook for your business, at least in the medium to long term, talking about 1 to 2 year, appears to be good because obviously the rates could edge higher. There is a scope for that?
The outlook based on the fundamentals appears to be good. Again, we are driven by global macro. If you have a global event, if you have a global recession, which results in lower demand for commodities and therefore lower demand for carriage of commodities, that could be a dampener. We don't know how interest rates, play out. So that could come in the way if you have those kind of macro events. But shipping industry fundamentals are good. That we can say. So that's one factor at least which is in our favor. And absent any macro event, we should be okay for the next year or two.
The other thing also, Mr. Shivakumar, is, and largely for your business, I mean, in the entire pie, how much trade actually flows from the Red Sea region? I mean, could it be a big dampener per se?
Yeah, these things on the margin make a big difference. The shipping market lives and dies on the margins. A couple of percentage points in utilization change has a big in the rates. And I saw a number that you'd put approximately 10% of the tanker trade goes through it, plus minus 2%, goes through the Suez Canal. And if you have if you have ships having to spend 40% more time, those ships, okay, that means the market is tighter by 4%. 4% in an already tight market is a big number. Okay, so and once that happens, then it's tough to call what can happen to the market. And it's on both sides. If you have a 4% drop in demand, it's the same, that markets could collapse. So, and dry bulk, the impact is a little less because you have only 4 to 5% of the dry bulk trade actually going through the Suez Canal. And those are typically smaller ships. So, it affects individual size ships a little differently. So all of those have to be taken into account. But broadly, any factor like this which causes inefficiency results in a tighter market and therefore higher rates.
Fair enough. In terms of the offshore rig business, tell us how many of your rigs and vessels will be coming up for renewal in the next financial year?
Yeah, in the next financial year, we have one which is being renewed right now. She's finished one of her contracts and she'll probably go on to the next contract, which is at a much higher level in the month of January. We have 2 rigs coming off their earlier contracts in FY25. They will be coming off their contracts. We will bid, one of them has already bid into a tender, which is a 3-year contract. Now, we don't know the results of that bid. And the second rig will be bid into a tender in due course when we get a tender which is appropriate for that timing. And both of those will get repriced in the next year, and that's in FY25. And in FY26, we have another rig coming up for repricing.
Excellent, Mr. Shivakumar. Thank you so much for chatting with us today on your business as well as what's happening as far as the logistics space, especially around the Red Sea is concerned. Thank you so much for your time.